Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. And today we have once again my good friend Doug Heagren. Hey, Doug.
Hey, happy Cyber Monday, Kirk. How you doing today?
Good. Waiting to empty my pockets for Cyber Monday. How about you?
I'm waiting to not empty my pockets today because I try not to get caught up in that craziness. Eventually we'll have to do something, or the kids will be extremely disappointed this year. But as of right now, we don't have a tree up. We haven't done any decorating. My wife wanted to go get a tree this weekend. The kids didn't want to go get it. And, after some pulling and pushing and shoving, verbally, it was just like, all right, forget it. We're just going to relax. So we're trying to delay as much as we can.
Well, I can't blame you. We don't get our tree till about the 15th or so, because if we get it now, it means the tree will be dead. It'll be well dead. It'll be a fire hazard by Christmas, and that's not a good sign. So we usually wait for about a week or two before Christmas. But we're definitely getting ready. And I noticed in the stores they had all the Christmas stuff up right around Halloween, which I thought was hilarious. I mean, every year it just gets sooner. I mean, at some point it's going to be 4th of July, and they're like, all right, Christmas stuff's coming out. Maybe that's their push to make more money. Maybe it's working. I don't know. What do you think?
Pretty soon they'll be playing Die Hard in August, to get you ready for the Christmas season. Now, I'm just throwing all the controversies out today, right? Because if you want to get people, Christmas movie passionate people to fight in fisticuffs, start asking them if Die Hard is a Christmas movie.
I actually saw a tweet yesterday that had the top 15 Christmas movies, and they started off with "Here are my 3," and Die Hard was one of them. That was hilarious. I never thought of it as a Christmas movie, but I guess, hey, there could be an argument made.
Nakatomi Towers. It's Christmas Day. It's a Christmas movie. Not every Christmas movie's got to be about Santa. Sometimes
wasn't the second one also a Christmas movie?
Every one of them. I don't know about the third. I don't remember the third, but you're right. It's Die Hard's a Christmas movie. That's right.
Yeah,
I believe she's in the air on the second one. She's is when she's stuck in the air and can't land.
Yep. And I think the third one was different. I think that was just Die Hard.
By the third one, they were divorced, and it was kind of headed down the Miss Doubtfire path. But different story.
Different strokes for different folks. All right,
that's right.
So Doug, what's in the news today? We got a lot of new news, and just in time for Monday. So what are you seeing?
Well, I think pertinent to the time frame, and speaking of Cyber Monday, we have Black Friday, which happened obviously last week. And they were kind of starting to get some numbers in from Adobe Analytics and from Salesforce. And they were kind of looking at kind of what happened 2021 into 2020 into 2021 and then 2022. There was a push after COVID to, away from soaring online growth rates of a lockdown population back to the physical store. And that actually resulted in a pretty sharp decline in those online growth rates. And it's kind of like inflation, Kirk. Just because you have a decline in the growth rate doesn't mean you had a decline, right? And that's kind of the situation. But what looks like Americans spent about $9.12 billion on Friday alone. Adobe Analytics had predicted about 8.9. So that's about a 2.3% growth rate on last year. And if they look at, tracking transactions at 85 of the top 100 internet retailers, it looks like there was some return to physical stores after the pandemic, but it looks like Black Friday is set to surpass online $9 billion in online sales for the first time. And interestingly enough, what would you think, Kirk, was the number one thing that accounted for online sales? Think about today's day and age. Think about what everybody needs, wants, uses.
I have no idea.
Smartphones. Smartphones were 55% of online sales on Thanksgiving Day itself, up from 51% last year. Tells you where American, I'm not just American because they track international data. Where's the world priority going, right? It's about smartphones. Everybody's tuned in. It was the old saying, tune in, drop out, or drop it, whatever it was. Well, I think that we're all dropped out onto our cell phone now. that's, it's, there's, and discounting is driving up average order value, which is up about 12%. I saw TVs had, again, had tremendous discounts, lots of sales. In the long run, I think the biggest thing is that if we look at that 3% year to year on year increase on a global basis on Black Friday. What's interesting though is, what have we been talking about week after week after week? What is the big thing hitting our economy? Inflation.
Inflation.
Right. So when you hear that there was a 2.5% increase, and by the way, electronics and accessories are 34% more expensive this year. But I was reading too, there's heavy discounts in beauty and makeup, so things balance out. But when you hear 2 to 3% increase in sales, but you look at, what have we been talking? 8, 6, 7, 8% inflation. The numbers are misleading a little bit, right? It's like it's up, but it's really down because it's not up at the same rate the prices were up, which tells me, I think there's a little bit that we have to read into that as to maybe a little bit of a dip in overall shopping, but they're not really talking about that. That's just something I kind of took away from it.
So that's a great thought, and appreciate that, Doug. There's something that just kind of came to mind as you were talking. So let's think about this for a moment, right? We have multiple factors going into this, and I know the media is going to spin things whatever way they want, right? And who's advertising the media? It's a lot of these retail companies that want to have things in a positive light and want you to spend more. I have no objection to that. That's capitalism, right? It's just it's just understanding the levers of news is really important, because when you hear things, it's not always true. It usually has some sort of slant or bias. But let's take those numbers that Doug just talked about, right? 3% increase in sales. Now, we could argue any one of these points. I'm just pontificating here. But, we have 8% inflation, right? So goods they cost more. But are people making more? No, right? It's more or less flat, right? Median income is more or less flat. Maybe they're making a little bit more, but it's not up significantly. But the population's increasing right around 2-3% a year, right? Which is interesting, right? So even if you have inflation of 8%, it doesn't mean that you're spending 8% more, because you have this certain amount of money to spend, unless of course you're going all out and putting money in credit cards and spending more than you have, which is certainly what the data shows. So my thesis could be totally wrong. We're just going off the cuff here, but I'm just trying to talk through this process to help you think differently about data and information you get. So one thesis is, well, the population is growing at 2 or 3%. That could account for the 2 or 3% in increase. So every time you see, hey, there's an increase, well, the population's increasing, median income generally is increasing. People could be spending the same amount, right? But the numbers will increase because the population's increasing. Now, if you have a country like France, which the population is pretty much stagnant, you're not going to see that, right? But here, everything is, if you see in a year, oh, it's more than last year. Well, it should be. If it's not, that would actually be a shocker, right? Some of the biggest demographic shifts are population growth. Inflation's a big part of it, but unless you have increase in income, inflation just means you're spending money in different places, right? So yeah, my food prices and gas prices have doubled in the last year. Well, that just means I'm spending less on clothes, shoes, whatever. I mean, which is true. I mean, I'm not really seeing anybody anymore, so I don't need those suits I used to buy. Don't need 50 pairs of clothes, because I never leave the house. I guess I do, but a lot of people work at home. So you don't need the same stuff that you needed 3 years ago. So the buckets just change. It doesn't mean it's more or less. It just means they're different. Now, some people go to work every day and they got to wear the same amount of clothes, and some people don't. The point is the buckets are different. So the inflation numbers, I was having a conversation with somebody over LinkedIn last night, and we were just talking about economic data, and it was interesting because it just came down to the answer, the conclusion. We were both kind of debating this a little bit, but the conclusion basically came down to, well, COVID screwed everything up, so we always got to put an asterisk. It's this, but because it's COVID, who the hell knows, right? You have to kind of throw that out, because COVID really threw a monkey wrench in the machinery. So as we talked about in the show, the bullwhip effect, it takes a while for things to work through the system. Like, things were smooth before, now they're not. So anything you say is a caveat of, yeah, but things could be really different because it's not normal. So I just wanted to throw that out there as a way to think about the data that Doug was talking about, because we don't really know, right? And did I spend more? No, I actually didn't spend anything over this weekend. I hate Black Mondays, Cyber Monday, Black Friday. To me, every time I see those videos of people fighting each other over a TV, it makes for a good Twitter laugh. I see these videos of people fighting. I mean, it's ridiculous. It's literally the last thing I want to be do is traveling and going to a store on the weekend of Thanksgiving. I want to be away from people. I want to be with my family, hanging out. I don't want to be near other people. I just want to be quiet, with my family. And so I hate that time of year. To me, it's just obnoxious that people really find spending to be the most important thing they could do on that weekend. But hey, I'm not judging. Just for me, that's my preference. And for other people, it's actually a part of their family tradition. Just like shopping on Christmas Eve was a part of my tradition, albeit stupid. It was part of our tradition. So I'm not judging. Just saying, for me, it's just not my thing.
Kirk, why were you not in church on Christmas Eve? I'm starting to get concerned. No, actually, going back to the shopping side of it, one more thing. They're thinking that today, Cyber Monday, they're predicting 11.2 billion in online sales today. So for the whole Thanksgiving weekend, they're looking at about $34.8 billion in sales, up 2.8% year on year. And by the way, one thing I want to add, and I'm a little bit off on this. I can't find the exact quote on this, but I believe I saw somewhere it took 100,000 years for the population to get to 1 billion. If you think of when humans started. So by 1800, it was 1 billion world population. It took 200 years. That's it. To go from 1 billion to 9 billion, or to 8 billion. Sorry. So, I mean, at that rate, they're predicting that by 2100, we'll be at somewhere in the range of 16.5 billion. That's going to cause some issues. We got some time to figure that out, but they better start figuring it out, because the population explosion is something that the resources on the planet are going to struggle to afford, which brings us back to inflation, right? Number of supply versus demand. So,
Yep. Well, I think that's actually a topic we're going to get into next week. We kind of put out a post here on LinkedIn here for next week's live. Actually, it's live on Friday, so it's not even next week. It's this coming Friday. We're going to be talking about how big oil is going to save the world, and we're all screwed without him. And one of the things that is really part of the conversation is global dynamics and global trends, and population growth is one of them. And I think that there's a little bit too much top-down manipulation of what people should be doing. It's far from a free market, and I think that is causing enormous problems. If you have a free market, there are problems, and they eventually get solved. But when you have people manipulating the system to do what they feel is best, sometimes that actually makes things worse. And I think that's what we're going to see here, and that's what we're going to talk about on Friday. So. We'll hold that until Friday, but I did want to talk about a lot of things here, inflation numbers, and Doug, we have a lot of charts here. So where do you want to start off?
Well, there's definitely a lot of. I think what's interesting to me of the charts that we were looking at is you put out some information that was from a group. I'm trying to think of who that was. Research Affiliates. And what I thought was really interesting, and this is something people kind of want to talk about, well, how long are we going to face this inflation, right? So taking a look at the Fed projections for the Fed funds rate at the year end, and kind of looking at where the prior 12-month inflation was. I mean, we're looking to sit and settle in right around where we've been thinking 9%, maybe a little bit of a dip. But Kirk, what's really interesting is how long that projection of high inflation could take until we get back down to something that we've been used to. We tend to think of 3%, roughly in the range of 3% as an average inflation over time. And it really has been, if you count all the years of inflation. But just like any average, right, it takes highs and lows. And we have been in very low inflation for a long time. I mean, sitting in inflation ranges of 1% to 2%. So guess what? How do you get 3%? You got to jack that up a little bit. And so what I thought was incredibly interesting and maybe a little bit scary is some of the charts and data and projections on how long it will take until we could potentially get back down below 3% since looking at where we, 1970. And if from kind of what I've seen there is if we're at 4% to 6%, it can generally take somewhere in the range of, let's just say 1.5 to 7 years to potentially get back down to 3%. But when you start crossing into the range of above 6%, 8%, 10%, 12%, 14%, what's interesting is based on that data, it didn't really matter how high inflation got, but there wasn't an increasing exponential amount of time it took to get back to 3%. It kind of flattened out at around 12, looks like about 12 to 14 years. So look where we're standing right now at 8%, Kirk. We're looking at, the fact is, if people are thinking, well, when is it going to slow down? If this data and these predictions are right, we're looking at not being back to 3% until 2035. Think about that.
Yeah, it's we're going to share these in the show notes for sure. But yeah, I mean, so what's interesting, and I'm glad Research Affiliates put out this report, and I'll put a link to that in the show notes as well. They put out some great data. So as Doug was saying, so Fed funds projections are in there, which to me, Fed funds projections are around 4.5%. 4.25, 4.5 for September, and if you look at the projection, you can see how far behind the curve the Fed really is. They didn't even start raising them until like December, or at least talking about it, and yet inflation was right around 7%. So I think what's important to take away from this is that right now we have high inflation, and it's a lot higher than it quote unquote the normal rate is. Right? Most people think, well, it's 2 or 3%. That's the target. Well, how do they come up with that target? No one seems to know. It's no one's explained why it's a good target. People just said, well, we look at history, or they just. I think it's possible the Fed just kind of pulled the number out of thin air and said, hey, this is a good idea, and they thought they could keep it, and they did up until this big paradigm shift, which we've been talking about for a long time. This big paradigm shift changed that, so they don't have the same levers to pull. Now inflation's higher, and if they're shooting for 3%, as Doug said, if you look at some of this data here, you're looking at quite a few years. You're looking at like 12 years, something along those lines, and we really don't know, but this is based on history and based on higher inflation. So if you look at this chart based on the number of years that it takes for inflation to revert below 3%, once it gets up to 8, you're looking at about 12 years. And that's based on history. Obviously there's a range between 17 years and looks like 6 years. But the point is once you get to high inflation, it tends to stay. It's sticky, right? You don't just hit 8% or 9% and then all of a sudden you just go down to 2%, right? That's not normal, right? It could happen, but it's not normal. And so what I think the point here is this really supports, and I'm glad these really smart research firms are coming out and supporting our thesis that we've been talking about for a long time, which is inflation is going to stay around for a while. So if you think that inflation is just going to go down and the Fed's just going to start easing and they're going to have a Fed pivot and everything's going to get easy as of January or June, good luck. It's not going to happen, right? Inflation is not going away for the reasons that we've talked about. Deglobalization, supply chain problems. You have money printing, which is not the reason. I know people talk about that's not the reason, but it is a contributing factor. And actually, some of the reasons we want to talk about today with Treasury bonds, which is another problem. But you have to think about, is this inflation going away soon? No. So you have to account for this in your own personal finances. And if you don't, you're going to get yourself into trouble. If you think that we're going to go back to quote unquote normal, which was completely abnormal, right? From a historical sense, low interest rates, low inflation of 2 or 3% was historically abnormal. Even though it happened for over a decade, like go back in history, the only times that's ever happened have been bubbles, other bubbles. No, we had I don't think he's on the show yet, but we had Edward Chancellor. We interviewed him for the his book, which I have right here, The Price of Time. Phenomenal book, but it gets into history of interest rates and interest. And it was a phenomenal data set, just looking at historically, like what's happened, why it's happened. And he's a really smart guy, and I have to say, I appreciate him coming on the show. So for those of you who I'll have to pull up the date it's coming out, but it is coming out in the future episodes. So highly recommend listening to that, and it'll give you some perspective of how things could happen here. You have our thesis. I don't know the future, but I know that it's not going to be inflation going down to 2 or 3% in the next year. That's I could say with a 99.999% certainty that's not going to happen. So if you want to make a bet, you can bet against that. So
well, and Kirk, and just to add a couple things, I think one of the flaws in this data is that it's looking at only what inflation drops and patterns could be were since 1970. Well, if you think about when we had high inflation last, it was the 1970s and the 1980s. So in one aspect, these charts are only really looking at the only time we've had inflation. One time of inflation in this. They're not going back and looking at high inflation in maybe in the 60s, 50s, 40s, 30s. So I think this data could probably use a few more cycles. But based on one other chart that you have here, that I think is interesting is even though it could take 12 years based on their data ish at this rate to get back to under 3%. Some positive news, if this is accurate, is when you look at how long it could take for inflation to fall by 50%. And if we are in the 8 to 10% range, according to their data, it looks like inflation could fall by 50%, from basically 4 to 6 years, right? So it's not saying that, not saying that we're going to get back to low inflation for the next decade, but it is saying that there could be some reprieve, that, we're not going to necessarily look at 9% annual for that a period of time. That if we do stay that based on history, if accurate, we may see like a little bit of a relief, a coming of half of this inflation, at least, hopefully in the next couple of years, which again, if we fall from 9 to 4.5, it's still going to hurt. It just won't hurt as much. I guess, pick your pain, right?
yeah, no, that's a good point. And I appreciate you bringing up that point, Doug, because we talk about this on the show a lot, is that the data set is really important. Most people, if you see these data points, it's like, oh, well, we kind of ignored the 70s and 80s and pretty much any time before that. Oh, in the last 20 years, this is the highest we've raised interest rates. Who cares? 20 years is not a data set. 20 years is a manipulation to show you a point and help a narrative. If you want to look back 100 years, that's a data set, right? A lot's happened in the last 100 years. You could argue whether it makes sense or not. But if you look back, really the big inflations, right? 1982 was the peak. June 1949. You've got July of 1932, and you got August of 1921. Those are some big data points. There's actually a good book here. I'm looking at the anatomy. Sorry, I can't speak. It must be the turkey. The Anatomy of the Bear by Russell Napier. Great book. Talks a lot about historical inflation periods. So if you really want to know history and understand what's happened before, obviously, if you look back in the 20s and the 40s, times were different. Data was different. We didn't have the internet. Things were very different back then. But I think what is the same is human nature. Human nature doesn't change. Even though the information changes, humans don't change. So the reaction to things isn't going to change. And that's what we're basing our thesis on here. And that's why we're trying to explain to you in simple terms is it doesn't matter what happens in the future. None of us know, and there's nobody out there who knows. But what we can tell you is how people are going to react, because we can just look at history and say, what do they do in the past? What are they going to do in the future? It's going to be the same. The details will be different, but humans reacting. So when we talk about how inflation, if you look in the 70s, is a great example. There were 2 oil shocks in the 70s, right, which had a big impact on this. But if you look at the 70s, there was inflation. And then politicians reacted to that inflation by doing stupid things like rent control, price fixing. We're seeing some of that in Europe. And those things
Sorry,
happen.
Kirk. I got to interrupt. I don't know how to process that. You said the politicians did something stupid.
Yeah, I
What?
know. I don't know, Doug. Maybe I'm just crazy. Maybe I'm one of those extremists saying things like that. But
Must be that tryptophan from the turkey still. No, continue. Sorry.
yeah, so I think the way to think about it is that people are going to react like they are in Europe, right? If you look at gas prices, utility prices, they're through the roof. Some, pubs and coffee shops have to close because they cannot afford their electricity bill. So what do politicians do? Well, we're going to fix electricity. We're going to cap it. What's that going to do? That means you're not going to have enough electricity. Because if the producers of electricity, if it costs them whatever, $5 an hour to produce it and they charge you, $10 an hour, okay, well, they're making a profit. That's the whole point of capitalism. But if they fix it at 10 and then their costs go up to 11, well, they're going to be losing money. So why produce any electricity at all if you're going to lose money? So they'll just stop producing electricity, which means there are blackouts, which means people don't have electricity. So the whole point of the free market, even though it's uncomfortable sometimes, is that it regulates itself. Doug, we always say this, what's the cure for high prices? High prices, right?
Mm-hmm.
What's the cure for low prices? Low prices. That's how capitalism works. So it may be uncomfortable at times, but that is the cure. And so if electricity, if people can afford $5 an hour and it costs $50 an hour, well, we're going to find other ways to charge our iPhones apparently. But I think the takeaway here is that human nature is not going to change. So the reactions of politicians and people are not going to change. They're going to be begging to, oh, I can't heat my home. I can't, turn on my electricity. And those are awful things. But, I think what people are not prepared for is a crisis. And I've seen, we're going to talk about this a little bit, but I've seen some people coming out with some information about energy crisis this winter. We may even have one in the U.S. this winter, maybe even in Boston, or so I've heard. So there's some energy crisis brewing in Europe, in the U.S., and globally because of what's going on in Ukraine, but also because of kind of what we're doing here. And we're going to talk about this all next week, so I don't want to get too deep into it. But the point is that human nature changes how things work. When normally you'd say, oh, well, supply and demand, it balances each other. But when you have outside influences manipulating that supply and demand balance, it causes problems. So,
hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute. But before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
Let's kind of move on from here. There's one more thing I want to talk about with bonds before we get into this, which is that, let's pull it up here. Okay, so there's a chart here, which, heck, I'm just going to share it here on the show because why not? Here we go. So I'm going to share this chart on the live stream. So here's a chart of, oh, I just messed that up. Okay. Here's a chart of bond yields. Now, there's a bunch of different types of bonds. There's treasuries, core agency, high yield, bank loans, emerging market, munis. It's all over the map. So what I want to point out is this is looking at December 31st of last year and then what is current. So if you see in blue, this is last year and the green is current. Huge change in bond yields, as you'll notice. U.S. Treasuries 1.2%. I don't know what maturity that was, but now it's 4.5. Maybe that's the 10-year. If you look at emerging market, was 4.4. Now it's 8.3. High yields 8.5. So you have a big difference. I mean, high yield 3.8. That's obnoxious. I mean, that's obnoxiously low. That doesn't account for risk. But now it's 8.5. So if you look at this chart, what that shows you is that bond yields have gone up a lot. Now, I've gotten a lot of questions. Should we start investing in bonds? We've talked about this a few weeks in the show. Yes, you should start looking at bonds. I'm not saying you should invest in bonds. I'm saying you start looking at them because there's a lot of opportunity in bonds now. Now, you have to understand what you're doing in bonds. And we talk about in the show, inflation is going to persist and interest rates are going to keep going higher. So do I think you should invest in bonds right now? I'm not. We have some very short-term bonds, but otherwise, we're staying really short-term because rates are going to keep going up. Now, at some point, rates are going to stop going up. Now, whether that's the Fed pivot or whatever you want to call it, at that point, that would be a good time to lock in some bond yields at a good rate. Now, the question is whether they persist. Do you lock them in for 2 years, 5, 10, 15, 30 years? I don't know. I mean, it's going to depend on what's going on at the time. And that's something you'd have to make that call. But if I can get 4.5% in a treasury, that's not bad. That's a heck of a lot better than 1.2 or in most cases 0. That's a big deal, right? So you just understand that bonds have changed. And also, you should also understand that this chart that we show every once in a while, this is important to understand. So this shows what a change in 1% decline of interest rates will provide you. Now, you could also look and say, yes, but a 1% increase would do the reverse. You can put negatives on all that. So if bond yields decline from 2 to 1%, you're making 24.6%. That's pretty good on the 30-year. But if it goes from 1 to 2, you're losing 24, which we've seen this year in the bond market. We've seen huge 30-year, I think it was down 30% or something like that this year, 30-year treasury. That's crazy, but that happened. So just understanding that bonds are not safe. If you're getting to 13 or 14%, that change is a little different. So this is a dynamic to understand. If you're going from 1 to 2%, you could lose a lot of money. If you're going from 13 to 14, you're actually, if you lose 7.5%, you're still making that 5.5% because you're making 13%. So even though you lose 7.5, you're getting that interest. So once the yields get a lot higher, there's a lot more wiggle room to make mistakes on where the top is. And so, I mean, if you could lock in 15%, that would be gold. And in some ways, I hope it gets back there. But if it does, we're all going to be in a lot of pain. So in some ways, I don't. Nobody wishes for the end of the world except for the bears. And then when they're right, they're still wrong because it's the end of the world. So you're not really winning. But I just wanted to point that out because I think people don't realize that interest rates are a lot higher. And if you're looking at your savings account in the bank, it's still the national average is like 0.18%. Banks are still not providing a yield. You can get CDs at one year for like 4.5%. Banks are still providing 0.18, 0.19 as a national average. So if you have your money in a savings account, you should look at putting it in the CD. You're going to get a lot better rates at CDs than you are in your savings account. So what are your thoughts on all this, Doug?
Well, do I have enough time for all those thoughts? Actually,
Sure.
so yeah.
We
So
got
I was
plenty of
thinking,
time.
so I like what you put there, because I think that you're right. At some point, there is going to be a time in which adding bonds is going to make sense. And the value that you're going to get on those bonds are going to be an incredible opportunity, not only for the actual interest rate that you'll make off of those, but the yield, which is, of course, the combination of the interest you get and the ability for it to appreciate when you look at where those values right now are currently recessed to. But I think you have another chart in here. Well, two things. I want to go back to the chart that you brought up there, showing the different types of bonds, and I want to make sure that this message is very clear for people. Of that chart that you threw up there, only a couple of the bonds that were listed on that chart are actually included in a general aggregate bond index. So if you look at 60-40 portfolios and you say, well, what does that mean? It's 60% equity, 40% bonds. Well, what is that bonds? Like if you were to buy the ETF AGG, well, core bonds is part of that. Treasuries is part of that. Mortgage-backed securities might be a little bit part of that. But bank loans, emerging markets, munis, IG credit, none of that is included in an AGG or aggregate bond index. So once again, you have to really understand fixed income and what you're investing in fixed income, because those things are not the same. And unlike equities, which tend to, and you know this, Kirk, they tend to be fairly correlated across the board. Whether you have, over long-term averages, small caps, mid caps, large caps, they tend to go up together in the same elevator. They tend to go down together in the same elevator. Now one of them may go up at the top of the elevator and the other one at the bottom of the elevator, but equities tend to be very highly correlated at positive times, negative times. Bonds can work very differently. Emerging market debt, muni debt, high yield bank loans can be incredibly volatile comparison to themselves. So you need to understand that an aggregate bond index only includes a couple of these things. And if you look at the highest potential current yield that exists right now in that fixed income chart, most of the highest yields are not in an AGG index or an aggregate index. So be aware of that when you think about fixed income and the difficulty it is of investing in fixed income. That's why the people on Wall Street that invest in fixed income are some of the brightest minds on Wall Street. I've met one of them. The gentleman held 27 designations. He was a bond trader on Wall Street in 1987. Of course, for him, he considers Black Tuesday one of the greatest days ever. But for the rest of America, not in the world, not so much. So there's some great minds out there, and a lot of some of the smartest economists that I have listened to actually started as bond traders. It's incredibly difficult to do a good job in bond trading. The other thing that I wanted to add into that is you have another chart that I think is really, really telling. Trailing 6-month U.S. equity bond correlations. Now, I want you, if you go back and look at that chart, Kirk, you can share it now or share it later. You go back into those correlations and notice when bonds and equities were correlated. Okay. Now, it only starts in 2000, so we didn't get to see 1990s correlation. But if we look at the correlations in 2004, 5, 6, and 7, notice the high correlation to U.S. equities and bonds right before the crash in 2008. Now you get into 2013. There was a little bit of a correlation there right before we had some volatility in 2014, but kind of minor. But go back and look at 2020 into 2021. We actually had high correlation that occurred at the end of 2020. We're seeing high correlation now in 2022. Now, again, this isn't an end all be all, but it does tell something to be very aware of, is that when the markets got the most volatile, right before the markets crashed heavily. And listen, you can say what you want about the current stock market. I find it very interesting, the number of people that say, I've lost all this money in the stock market. And I'm still sit there going, really? because the current valuation of the S&P 500 is still higher than 2020. We really haven't come down that much, Kirk. But if you think of that correlation right now, and you think about the calls for recession that are still very much in unison, right? Go back 2 years ago, weren't too many people calling for a recession anytime near. Now, there's a lot of thought that says that recession. Now, I know some people still argue we're in recession right now. There's, the GDP, multiple quarters of negative GDP. I remind people that GDP only includes finished goods. Okay. So if you really think of all of the products and parts that go into any finished goods, like think of all of the parts that go into a TV, right? GDP only counts the TV, but we know there is a lot of other components and sales, wholesales parts, electronics, plastics, you name it, that go into the creation of a TV, and none of that gets counted in GDP. So we look at the flow, and we look at the sales, and we look at what's happening with consumer spending. Yeah, let's face it. Does it really feel like we're in a recession if you look around and think of how much people are spending on travel, how much people are spending on goods? It's still really high. You're going to know when you're in a recession because everybody is going to feel the pinch. And so a lot of people think a true recession, end of 2023 into 2024, who knows, right? It's a prediction. But if we get to that, and right before we go into those recessions, usually the stock market tends to precede them. And yes, we've seen a casually sustained dip in the market, but we certainly haven't seen a crash in the markets, Kirk. We know what a crash looks like. Go back to the end of the .com. Go back to 2008. Go back to many of the other times. Go back to Black Tuesday. We know what that looks like. Well, if we look at some of these patterns here, trailing 6-month U.S. equity bond correlations, I find it very interesting that the correlation of bonds and equities were very much in sync right before the fall. So as we're talking about when to get into fixed income, here's what historically does happen. It doesn't matter what yields are. And it's certainly not saying bonds are safe, because you've seen in this past year, we've lost more value in bonds than equities lost on a year-to-year basis back in 2008. But when push comes to shove, when markets crash, people look for places to go to protect their funds, and they tend to move, especially to U.S. Treasuries. Okay, so I don't think it's a good time to get in it right now because that correlation is so heavy and there's a possibility of greater dip. But I do think if you look at where those values are, where those yields are, and the fact that if we do have a major market crash, people tend to try to fly towards perceived safety. I think we are coming to a point in which those correlations could disconnect very, very rapidly. And at that point in time, you're going to want to have more than just equities in your portfolio. And ultimately, in that correlation sense, again, it goes back to what I've said before many, many times and many conversations we've had. True diversification is not having multiple things that you like that are different. True diversification is looking at your portfolio and not liking something. If you like everything, you're not diversified. You've got to have significant distaste in something in your portfolio to be diversified, which I think also goes back to another image you've got thinking about your objectives that we can certainly come back to as we wrap up today. But make sure that you are diversified. And unfortunately, Kirk, too many people just aren't.
Yeah, I want to touch on a few things here. So getting into this correlations, this is actually kind of thing that I love to dive into because correlations are something that most people don't understand. And basically what a correlation is it's how one thing compares to another thing. So 0 means that they're not correlated at all. It means, if one thing goes up, the other thing is totally unrelated. A negative correlation means if one thing goes up, the other thing goes down. Positive means if one thing goes up, the other thing goes up to different degrees. So that's really how to look at this. Now, I want to point out that this is interesting from a few different perspectives. Now, one thing is you can look back before 2008 and say, wow, there was a positive correlation before that. Now, I think the thing to take away from this is there's correlation and there's causation. And people get these confused. they say, well, there's correlation, so it must be causative, right? Oh, well, things were positively correlated, so that must mean that there's a recession around the corner, right? Or it's, it's negative correlated, which means things are normal, right? Which is kind of the normal way people talk about it. But it's not necessarily true, right? That's a correlation, and that's something to be mindful of. Is it causative? Not necessarily, right? Now, this is a good example. Historically, stocks and bonds have a negative correlation to each other, and that varies based on market conditions, as you can see here. So historically, there's negative correlation. But as you can see, it's not always, right? It's not always negative. So if you look at this year, there's been a positive correlation. Pretty much no matter what you're in, unless you're in energy companies or cash, you pretty much lost money this year. Even gold, the inflation hedge, pretty much every investment lost money this year. So that is not normal, right? If you look at the historical correlations, you'd say, wow, that's weird. Bonds are supposed to protect me from equity losses, but they didn't. And so 60-40 portfolios, you can pretty much throw them out the window. Now, the reason is it's not causative. The reason is we so happen to be in a bubble that was based on credit. And as interest rates were going up, bond rates go down, which also means stocks should go down because interest rates are so low and now they're going up. Now it takes more. If you're going to borrow money, it's going to cost you more to borrow money, which means the companies will borrow less, which means they won't expand as fast, which means, the stock market's going to drop. So all of these things came together at the same time. You could say, well, this thing almost never happens. Well, yeah, it almost never happens except for the 70s, the 40s, the 60s, the 20s. Of course it happens. It happens. And it's part of a normal market cycle. It doesn't happen all the time. It didn't happen in the last 20 years up until recently. But you know what? I can guarantee you it's going to happen again in the future because that's how markets work. So I point this out because we see correlations a lot and people try to draw conclusions, and it's not always causative. So I'm gonna share something with you guys here, and it is a chart that I usually use when I'm talking at conferences, and I love this chart. So hopefully you guys do too, which is correlation versus causation. So you have a inverse correlation, right? So it's kind of like bonds, where one goes up, the other goes down. And the bottom one is positive correlation. Well, if you look at this, the top one is honeybee producing colonies versus juvenile arrests of possessing marijuana. You would think that those are not at all related, but there's a very high correlation, an inverse correlation here that, honeybee producing colonies and juvenile arrests for possessing marijuana. It's totally ridiculous to think they're related. But if you look at this, you'd say, well, obviously they're related. I mean, look at the chart, right? Look at the bottom one, divorce rate in Maine and per capita consumption of margarine. Well, maybe you could draw some conclusion there. I'm not going to stipulate that one, but
Kirk, there might be a correlation between heart attacks in Maine and the per capita consumption of margarine. I think that correlation could probably be linked. But interesting that people that eat more margarine are getting more divorced.
Yeah, so you could draw it whether it's causative, but the point is that is a very high correlation. But any normal person would say that's partially ridiculous, although we could joke about it. They should not be related. So I think the takeaway here is understanding the difference between correlation and causation. So when you're looking at charts, don't look at a chart as if, well, it's correlated, so it must be true. We don't know if it's true. We have no idea if it's true. But you can look at it and say, all right, does this make sense beyond the data, right? Like I just showed you two charts, which are data which should not be related. But you look at stocks and bonds, well, the data is related and we can understand why, right? You understand why because as rates go down, let's put it this way, if stocks go down, then bonds should go up because it means people are pulling money out of stocks, right? So why do stocks drop? Because people sell them, right? So people are pulling money out of stocks and they're putting them into bonds, which means bonds should start doing better because more people are buying bonds. But what more people buying bonds means rates drop, right? So there's an inverse relationship there. But understand that, and I hate to quote Jim Cramer, but he said there's always opportunity somewhere. which the point is money is, you can think of it as like a finite amount. Let's say there's like $1 million in our economy, and it's floating around, right? It's in different places. Let's say a bunch of people are investing in different things. Well, all of a sudden they say, well, stocks are going down. So they take that money and they go put it over here. Well, this thing's going to do well. Well, mostly that thing is bonds. And so normally, in a historical sense, normally when stocks go up, bonds go down, unless you have interest rates going up, which are being pushed up because they were artificially low for a long time. And this gets back to that quote unquote 2 or 3% target rate that the Fed has tried to stick to, which is nonsense, because who knows what the actual rate should be. They just kind of pulled it out of thin air. Now, I want to get to one more point, and then I want to get to real estate, and then we gotta jump here. So let's look at this chart, because this chart I think is really important. I wanted to name this session a little different. I wanted to call it the default of U.S. Treasuries, but I thought it might be a little bit provocative. So this chart's really important to look at. This chart's, I think, from J.P. Morgan, but there's two charts here, and I'm sorry, I'm not sharing it. Let's just see. Here we go. Share it, and there we go. All right. So here's what this chart shows. It shows the liquidity of treasuries and the amount of treasuries. So on the right, it shows there's an enormous amount of treasuries created in the last 30 years. Okay. If you look back to the early 2000s, there was less than 9 trillion of treasuries. Now there's about 24 trillion of treasuries outstanding. That's a huge jump in a matter of whatever, 13 years. Now, if you look at this, a similar chart, which is not exactly the same time frame, which I'll warn you again, it's always about the time frame, right? What are they trying to prove as a narrative? But I think what they does show is important, which is, what is the liquidity? Well, there's a lot less liquidity out there for buying treasuries, which means that there are fewer people buying more treasuries. So if somebody went out, and this is the hypothesis, people like Nouriel Roubini and a few other people come out and they say, well, somebody like China comes out and dumps treasuries, we're going to be in trouble. Well, true, but they're going to lose too. So I never really understood that thesis. It shows a good narrative, but why would China sign up to deliberately lose a ton of money? To me, it doesn't make sense. But okay, if you're at war, maybe that happens. So let's just put this theory out. Let's say it's not China. Let's just say people decide after December, they say, wow, I've lost a lot of money in bonds. I'm just going to, not invest in bonds anymore. Or we're going to sell our long dated treasuries or whatever it might be. They just start dumping bonds. Well, the chart on the left shows there's no liquidity, which means there's no one out there to buy it. When that happens, that's what we call a crash, right? Is when there aren't enough buyers for the sellers. So if you look back in 2014, was it? I think it was 17. Yeah, 2017. No, 14. It's been a while. Turkey brain. So if you look back then, we had an oil crisis. Oil went from $100 down to the high 20s. And what happened is that caused a lockup in the markets, in the bond markets, especially for oil and gas companies. So what happened was all these companies were flushed with cash, but now that oil prices are no longer $100, now they're at like 20 or 30, they're no longer profitable. So people were dumping these, they're typically high yield bonds. They were dumping these high yield bonds on the market to get rid of them, but nobody was buying because they knew that these companies were going to go bankrupt. So there was no bidders. No one was buying them. So what is it worth if nobody's buying something, Doug? Zero, right?
Yeah, zero. Nobody wants it.
Right. So if you're trying to sell, I'll give you a perfect example. We got this piano, right, from our relatives, and they didn't want to sell it or they didn't want to dump it, so they just gave it to us. And we figured, all right, we'll just take it because maybe the kids want to play the piano. Kids have no interest in playing the piano. So now we got this piano sitting in our living room. So we're like, all right, can we sell this? There are no people willing to come and buy this piano. It's a good piano. There's nothing wrong with it, but that's not the point. The piano market, there is no secondary market unless it's a really priceless piano. So not only is there no one to actually buy it, so it's worth zero, right? Not only that, I have to pay somebody to pick it up, which means its value is actually negative. So I have to pay someone to pick up this piano that was given to us. So actually, by taking this piano, it's going to cost us a few $100 to get somebody to remove it. So that's what basically happened in the high yield bond market in the energy space. about 10 years ago, is that when you don't have liquidity, that it's worth zero. So this is the stipulation that people are making, is that, well, right now the liquidity is really close to zero, and there's no one to buy these. If somebody dumps it, we're all screwed, and the treasuries are going to go from 4% up to 20 or 30% overnight because nobody's willing to buy it. Well, I could tell you, Doug, I'm just going to, you know what? I'm going to tell all our friends here who are listening. If US treasuries go up to 15, 20, 30% overnight, I will be the buyer. I will buy that. Okay. I'm just going to say it out loud. If anyone wants to sell me their treasuries where I'm yielding 30% for 30 years, I will be the buyer. Okay. Just show up at your door. I don't know where I'll find the money, but I'll dig up money from somewhere.
Kirk, do you remember high yield fixed income in 2008?
Oh yeah.
Beautiful.
Yep. So that's the important point I wanted to leave you with here at the show. I'm going to let Doug talk about the remaining charts here with home prices, but this chart is really important. It's something to understand. It's not just about yield, it's about liquidity. If there are no buyers and there are a lot of sellers, it means that the price is way too high, and that's what sets up for a crash. So just be careful. And, this is why I'm not ready to buy bonds yet, is that I don't think we're ready for this. I think there is going to be a point where bonds are going to go a lot lower in price and higher in yield. And I don't think we're there yet. When we have inflation at 7.5%, 7.5% and change, and right now we have treasuries at 4.5%. We're not there yet. The Fed is really behind the curve. So rates will go higher. We'll see what happens. Like I said, I can't predict the future, but the data lines up to suggest that rates are going to go higher, and it's time. If you are going to invest in bonds, there's nothing wrong with it. We are investing in bonds. Go on the short end of the maturity spectrum. Go 3 months, 6 months, 1 year. If you go further out, you're locking in lower yields because yields are going to go up in the next 6 months, or at least I don't see how they couldn't. So you could get higher yields then. So if you're going to lock in a few years, wait till we stop going up in rates. That's a good time to lock in yields further out if you feel like you have to. So go ahead, Doug. What else do we have here on the docket to share? We got a bunch of charts here.
Well, you mentioned housing, so let's just go right there. You've got a chart that talks about, and we've talked about this, and anybody looking around their neighborhood can probably nod if watch giving yourself whiplash because purchases of mid and high priced homes have dropped over 30%, and the purchases plummet. I mean, the housing market has slowed. We had a Q3 2022. A 30% decline in the year-over-year change in the number of homes bought by investors. Now, I do want to pause on this a little bit, Kirk, and make sure that for one thing, that those numbers could be very highly skewed based on the fact that it's Q3. Like, we always have a slowdown in housing purchases in third and fourth quarter, right? The time real estate makes its money is first quarter, second quarter, predominantly, maybe early third quarter, right? But once school starts, people just generally don't move. But at the same time, if you were to take, and you can look at some of the patterns here in other Q3s. I mean, if you go back to Q3 2019, there was a dip. Q3 2017, little dip, but not like this. And overall, if you look at low-priced homes and you look at high-priced homes, there's been a dip of negative 35.7% drop year to year. Low-priced homes, though, and this is really, let's face it, Kirk, this is where a ton of the money was flowing previously. I mean, a lot of investors were bidding cash offers to buy up as many low-priced homes they possibly could to either flip them or to turn them into rentals. And that has been a 20% decline year over year. And okay, and again, I'm going to go back to what people always say. Hey, home prices never go down, Kirk. Well, I don't know about you, but this chart's calling a lot of liars out there.
I would agree. So I think, looking at this high, mid, and low price homes, I think this is an important chart because, when you see like median home price, that includes everything. And obviously the market is very segmented, between location, between price. And so I think this kind of aggregates them all. So I think it's a good chart to show just the difference. Now, I think if you really look at the chart, you'll notice it's pretty much the same. just because they don't start the same doesn't mean that they're, I mean, high price and mid price are definitely going down more, which I think is understandable. I mean, I know around here, I mean, we live in, in the Boston area, and there's a lot of expensive homes. We have towns around here that are like the top 5 most expensive towns in the U.S. So things aren't cheap here. But if you look at the high price homes around here, I mean, we saw home prices double more or less in many ways in the last few years since COVID, which is kind of ridiculous because they're definitely not worth that. But people were paying because they want to get out of the city. And now those prices are, if you look at this, the prices are dropping. Now, I haven't seen a lot. I've seen a lot of people with home price signs on their lawn, and those prices haven't dropped, which is interesting to me. So, if you see what's been going on, people are still sticking with, well, this is my retirement. I got to sell at this high price. I'm not willing to go down because I don't really need to sell. So there's a lot of, let's call it, tomfoolery, to use an older term, going on in the market. And I think that'll kind of work itself out as real estate tends to move slowly. But I think that the bottom chart here is really important, which is showing home purchases, which have dropped significantly. And the last time we saw that was COVID. And you look at the after, home prices went up 141%, which is crazy, in 2020. So I think what's important to realize is that if you look at these numbers, they ebb and flow, right? So if you look at 2005, home prices peaked. They bottomed around 2009, 2010 in terms of number of home purchases. So you see there's a kind of reversion to the mean, and we saw a huge spike, which we didn't even see, prior with the housing bubble, going up 141, going up 81. I mean, those are crazy numbers. So we should probably see some spikes down in the near term, which we've certainly been talking about on the show. I also want to point out there's the U.S. metro areas where home prices are falling the most. I just point this out. We're at the bottom, but we're still in the mix. San Jose is down 10%. I mean, these numbers, you could say, wow, that's a lot. I don't think that's a lot compared to what interest rates are. I think we've just scratched the surface. You notice most of this in California, but I think we've just scratched the surface in this. And the fact that, Boston's only down close to 3%, I think it's, Boston actually is one of those places well insulated because of the diversity of the economy. But go ahead, Doug.
Well, go back to the previous chart. I mean, yeah, okay. So investor home purchases plummet 30% year over year in Q3 2022. And we saw, as we talked about, 20 to 35% decline in prices. But just go back 2 years before that, or a year before that. Look at how much home purchases spiked previously. I mean, go to 2021 Q3, if I'm reading it to charts correct. I mean, basically, home prices were up 141%, then 81%, then 7%. So cumulative, you're talking about a spike of basically 230%. My math's correct, right? So if you look at how much those prices have come down in relation to where they were driven up in terms of that limited supply, but massive demand, low interest rates, yeah, I agree with you, Kirk. They haven't come down much at all. And again, it is Q3. Q3 sales in real estate typically are worse than other quarters. So I'm really curious to see. I wouldn't put a lot into this chart yet. But as we start to round out the year and get into Q1 and Q2, looking at just kind of patterns here, if we start Q1 with a significant decline, I think that sets up for an incredibly dangerous situation in real estate, because if they don't make their money early in the year, then next year is going to be an absolute disaster. And just looking at some of the data that's out there on this, there is a lot of projections that we are going to see incredibly dark days to come for real estate.
Yeah, I couldn't agree with you more, Doug. We're going to keep talking about this and keep showing you data on the show because, quite frankly, real estate moves slowly and people don't believe us. They don't believe us that the real estate's going to get worse. Anybody who's in real estate knows, but other people, other economists, they say, well, it'll be fine. And I don't think they understand the numbers. But we're in the interest of time, we're going to wrap it up here. But I did want to point out this one last chart, which is showing U.S. investors are buying record number of China options. I think this is the FXI equity options. So I only point this out because it's just interesting, right? If you see the data points, you see kind of what's going on. And I don't want to push one thing over another, but we'll just use this index just as an example. And I don't think they're the only one, but China has gotten decimated in the last 2 years in terms of their equity markets, and you could argue whether that's warranted or not. But I think pretty much this went from 54.5 at a high last year, and it hit a low of 20. So it's down more than 50%. So people are buying equity options. They're thinking, oh, well, this is a good time to buy. I don't know if it's a good time to buy or not, but I think it's just an interesting data point to see there's a huge spike. And if maybe this is the retail market that's buying these, I'm not touching them. I don't like the direction of where she's taken the country, and maybe they think it's a good idea, but personally, I think it's not setting up a positive economic environment when you go from a pseudo free market to more of a command and control economy. I don't think long term that's a good idea. So we'll see. I'm sticking away from China. I've learned my lesson years ago not to touch the Chinese markets. They're just it's not a free market over there. So, but yeah, Doug, final thoughts, and where can people find more about you?
Well, thanks, Kirk. I think the final thoughts are, as we talked about today in summary, I want to go back to making sure that people understand how to think about their finances. And unfortunately, I had a conversation with someone about this recently. People think it's always about the stock market. What rate of return can I get? And that is the one thing that is out of your control. Okay. You can influence it. You can certainly try to protect your portfolio, but if you have no control over rates of return, and too many people are convinced that this is how you win the game and that this is how you judge any financial advice that you get. So go back, think about your objectives. You want to make sure you're generating income, regular predictable streams of revenue. Again, if you had a pension that covered everything you need, you wouldn't care about the markets, right, Kirk? I mean, if I had more money coming in every month, and I have some clients that have that, they have more money coming in every month than they need, they don't care about their investments. It's never something that comes up because to them, that's just something for fun, for whatever. Second is diversify your portfolio. Again, smooth out the highs and lows. If you don't dislike something in your portfolio right now, you're not diversified. Protect your investments. Use things, again, this chart, you've got this thing that says use treasury CDs or other highly rated bonds. As we would say right now, that may not be the way to do it. There are other ways to do it right now to protect your investments. And again, some of that is having the advice and planning of an advisor that actually looks at risk and manages that. And of course, tax benefits. Taxes are a fee. If you're worried about cost in your portfolio, but you're not worried about the taxes in your portfolio, then you're not really worried about the true cost. So make sure you're set up correctly, and make sure that you're buckling in because, Kirk, I don't think we're out of the hard times. I think that we really haven't seen them yet. And I think that's going to come. I mean, they're predicting potentially up to 20% decline in housing prices next year. We can get more into that in future conversations. But if you're sitting there looking at your home equity as your bank for your future, I'd be really concerned right now. But let's talk about the last thing, where to find me. If we're concerned about inflation, the number one area of inflation that people typically have been facing is college costs. We have a free report. You can download it at ProCollegePlanners.com. Get a look at what cost is going to college. So if you have, college is going to cost for you. So if you have a child, 8th grade or higher, that's planning to go to college, you can't afford to wait on this. Get started now. A lot of people wait till senior year. We call that the college funding pressure cooker. Look us up, ProCollegePlanners.com. Download our free report. Get our free ebook, and contact us at info@ProCollegePlanners.com for more information.
Great. Thanks for joining us again, Doug.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.